Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2 and beyond, I want to focus on the outlook for 2025 and my thoughts on many of the executive orders that were signed by the president this past week. So we'll focus on the Tax Cuts and Jobs Act, the U.S. deficit, new tariffs, and the economic impact, along with energy policy and changes, immigration and the job market, the Trump trade, and of course, growth of the economy based on who is in office. So let's hop on into today's conversation.
Now, on to point number 1, the market recap.
First, each week we review the Atlanta Fed's seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report was not updated, so unfortunately we don't have any new data to show here. However, GDP trending at 3% is strong. Next, each week we look at initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data rose by 6,000 claims, ending at 223,000, while continuing claims also rose to 1.899 million. We'll continue to watch this metric closely while the new administration continues to make waves. I fear we may see this tick higher in the upcoming months. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw a slight downtick in the 30-year and 15-year mortgage rates, ending at 6.96 and 6.16% respectively. Next, we'll look at investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull to bear spread jumped from negative 15.14% last week to a positive 14% this week. This is great to see, as investors are now feeling more bullish in the market. I believe they have reason to be as well. Markets are doing well, and earnings season has been strong. Fundamental values continue to remain high. However, there's still opportunity for further positive movement. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 2.1% probability of a 0.25% decrease and a 97.9% probability of no decrease in January. The probability of a decrease in January continues to come down looking at this data. As we move on to next week, the Fed's FOMC meeting is scheduled for January 28th and 29th. We'll certainly take time to report out on that next week, but for now, the market does not anticipate further rate cuts. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 1.76%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 1.40%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was positive 3.17%. International stocks took the win this week. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Now, this week, President Trump's inauguration marks a significant political shift amid market and economic uncertainty. The stock market had rallied as much as 5.3% with dividends in the month following the November election, before giving up about half of those gains at the start of this year. As President Trump begins his second term, both Wall Street and Main Street are wondering what the next 4 years may bring. Investors face a complex environment in 2025, with steady economic growth balanced against fewer Fed rate cuts and high valuations. This is one reason investors should be more sensitive to growth policies than in the past. So, while the president has already signed dozens of executive orders, many of the new administration's policies details are still uncertain and could change in the upcoming weeks. However, key areas will certainly include taxes, fiscal spending, trade, energy, and immigration, all of which could impact the economy. So, let's dig into these topics in more detail. The Tax Cuts and Jobs Act. With the new Trump administration and Republican control of Congress, it's likely that much of the Tax Cuts and Jobs Act will be extended beyond its 2025 expiration. The political details of how this makes its way through Congress are still being debated, but this means that tax rates will likely remain low for individuals and businesses. This includes a highest marginal rate of 37%, a corporate tax rates of 21% or lower, a higher estate tax exemption, and more. While taxes have a direct impact on households and companies, they do not always have a straightforward effect on the overall economy and the stock market. Tax rates represent just one element affecting economic growth, with numerous exemptions and provisions available to lower effective rates. Current tax levels remain below historical averages. Given its increasing national debt levels, prudent individuals should consider the potential for future rate cuts in their long-term planning. Now let's talk about the United States national debt. Many economists and investors expect the federal debt to continue to grow. Tax cuts and other policies only worsen annual deficits. In 2024, the government spent $6.75 trillion, resulting in a funding gap of $1.83 trillion. Ballooning the national debt to over $36 trillion. Neither party has made serious efforts to rein in the deficit in recent years, especially as the country has dealt with various crises such as the pandemic and inflation. While many Americans would prefer the government to operate with a balanced budget, just like we do at home, it's unclear whether Washington or any attempts from the new administration will be successful. On to tariffs and the economy. It's important to remember that political rhetoric can differ from actual policies. Nowhere is this potentially more relevant than with trade. President Trump spoke on many occasions about his plans to impose a 10 to 20% tariff on all imported goods, along with an additional 60% tariff on Chinese goods. More recently, however, he has discussed a 25% tariff on Canada and Mexico, saying that on Inauguration Day he will enact them on February 1st. During his first term, the Trump administration did, in fact, raise tariffs for many trading partners. This led to negotiations and trade deals, including the USMCA, or the US-Mexico-Canada Agreement, and the Phase 1 agreement with China. Many of these tariffs were then continued under President Biden. The U.S. currently has the largest trade deficit in the world. As of November 2024, the U.S. imported $78.2 billion more than it exported. This is not necessarily a bad thing. It just reflects the strength of the economy and the U.S. dollar and a healthy consumer demand amongst Americans. However, this does mean that the country is effectively borrowing from the rest of the world. Tariffs are a minimal source of government revenue, making up less than 2% of federal receipts each year. Many also worry that tariffs could contribute to inflationary pressures by raising the cost of imported goods entering the domestic market. From a political perspective, these concerns must be weighed against protecting sensitive intellectual property and preserving the domestic manufacturing jobs. Now let's talk about energy policies. Another key component of Trump's agenda is the focus on energy security and dominance. He has already declared a national energy emergency and will create a National Energy Council to expand drilling in places like Alaska. According to the U.S. Energy Information Administration, the U.S. has produced more crude oil than any nation at this time for the past 6 years. The U.S. is also the world's biggest gas producer and exporter of liquefied natural gas. Oil and gas drilling is naturally politically controversial. The Biden administration recently banned drilling in parts of the Pacific and Atlantic Oceans, the northern Bering Sea, and parts of the Gulf of Mexico. Some of these bans have already been reversed, and Trump's Interior Secretary has already vowed to reverse the rest. For markets, greater energy supply could mean more stable prices, especially as geopolitical conflicts continue to rage around the world. However, the impact of decrease in gas prices should be really understood. The trickle-down effect would be minimal to consumers, and the vast majority of savings would be at the first point in the supply chain. Now, let's talk about immigration and the job market. Politicians in the news typically focus on undocumented immigrants, especially with Trump's immediate declaration of national emergency on the southern border. However, immigration policy changes could impact legal immigrants as well, especially highly skilled workers. A reduction in immigration could have implications for the labor market, particularly in areas where worker shortages are already a concern. There is a disagreement within the Republican Party over visas for skilled foreign workers, and the H-1B visa program, which enables companies to sponsor these workers, has been a particular point of contention. Recent jobs data shows that there are still 1.2 million more job openings than unemployed individuals, so immigration policy could have a significant impact on the economy in the upcoming years. Now let's talk about the Trump trade and how it's taken a little bit of a pause. President Trump's election victory in November led to a rally in many asset classes associated with the Trump trade. This refers to investments that benefited from the expected policies of the new administration, including lower individual and corporate taxes, tariffs-led regulation, and deficit spending in areas such as infrastructure. This propelled markets for a time after the 2016 election as well. Other assets, including cryptocurrencies and artificial intelligence-related stocks, have also benefited. On the contrary, the sectors that Trump didn't favor did not follow this trend. Despite investor enthusiasm, the stock market never moves up in a straight line, and this was also true during the first Trump administration. Investors should continue to stay balanced to benefit from both current market conditions and to protect their portfolios during periods of volatility. Now let's take a look at how the economy has grown under both parties. I've said this before, but when it comes to markets and the economy, presidents tend to receive too much credit and blame. History shows that economic growth and the market rallies have occurred across both parties. This is because who occupies the White House is often less important than the decades-long business and market cycles that happen to be taking place during that time. So, while good policies do matter and can drive productivity and growth, there are many underlying factors that can impact investors more than which party happens to be controlling Washington, D.C. Economic growth is more a function of how well you, the consumer, are able to spend. This is because GDP, the United States GDP, or gross domestic product, is nearly 70% consumption based. So, if the American people are growing and have the ability to spend, then they can drive the economy forward and strong. I highlighted 2 points on the graph where we saw significant decreases in GDP. The first was the 2008 Great Financial Crisis, and the second, the global COVID-19 pandemic. As you can see, in both instances, the economy not only came back, but grew significantly since. The bottom line, over the next 4 years, investors will be focused on the new administration's policies and their effects on the economy and the markets. For investors, it's always important to put politics aside, to stay balanced, and focus on your long-term goals versus the short-term changes. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, make sure to hit that subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you again for watching. We look forward to seeing you next week.